ServiceNow beat the quarter and still got punished, which is kind of the whole point today. This is Earnings Unscripted, and we're talking ServiceNow, ticker NOW, Q1 2026 on 2026-0422. For anyone who doesn't live inside enterprise software, they're the workflow platform behind a ton of IT, HR, customer service, security, all of that corporate plumbing. Q1 looked good on paper. I mean, really good. Revenue was $3.77 billion, up 22% year over year. Subscription revenue, $3.67 billion. Non-GAAP EPS, 97 cents. And non-GAAP operating income was about $1.2 billion for a 32% margin, broadly ahead of expectations. And yet, the stock dropped about 10% right after the print, hit an extended hours low around 87 after already having a rough quarter. So, what did the market actually hate?
Look, the clean answer is not the income statement. It's the contract backdrop. We don't get a neat standalone Q4 bridge, or rather, not enough for a clean sequential P&L comp. But the sequential tells that do matter. RPO and CRPO both slipped from Q4. Total RPO went to $27.7 billion from $28.2, current RPO to $12.64 from roughly $12.97. Management says that's classic Q1 seasonality after the big Q4 enterprise and federal booking cycle. Fair. But when a stock has already fallen more than 31% during the quarter, investors hear slower backlog and stop listening.
So, okay, good headline numbers, a slightly less comforting future revenue line, and the tape chooses panic.
Pretty much. Although the core business still looks strong. Free cash flow was $1.66 billion with 44% margin, and they raised guidance. The more interesting thing is that ServiceNow is changing what kind of software company it is. McDermott said 50% of net new business is now non-seat based. So tokens, consumption, connector fees. That's a big deal in an AI cycle, because if customers cut headcount, old SaaS seat math breaks. ServiceNow wants to get paid for work done, not just employees counted.
Which is, honestly, a much smarter pitch. Charge for outcomes, not badges on lanyards.
Right. And they gave a very human example. Robinhood is using the platform to deflect 70% of internal employee requests before a person even touches them. They also talked about support work going from roughly 2 days to under 20 minutes. If that's real, consumption pricing isn't just marketing fog, it's monetizing saved time.
Also, tiny legal umbrella here. This is not financial advice, just our personal opinions after too much time with enterprise software filings. What else makes this quarter feel, less simple than the press release?
Two things. First, geopolitics actually hit revenue recognition. Subscription growth took a 75 basis point headwind because some sovereign cloud, basically on-premise Middle East deals slipped due to the Iran conflict. That's oddly concrete. Second, the balance sheet is getting more active. They did a $2 billion accelerated buyback, took out 20.2 million shares in Q1. Cash and short-term investments fell to $5.18 billion. And now ARM plus Vesa means this very clean SaaS story has M&A and financing texture all over it.
Financing texture is a very elegant way of saying analysts now need 3 extra tabs open.
Yes. And there's one buried issue we should not lose, though. The federal investigation around hiring practices and public sector risk. It's not the headline tonight, but if you're underwriting government growth, it matters.
So the short version is they beat. They guided with confidence, but the market is staring at softer sequential backlog, a changing monetization model, acquisition drag, and one very uncomfortable footnote.
Exactly. Good quarter, harder story. Sometimes the stock isn't arguing with the numbers, it's arguing with the new shape of the business.
All right, let's get into that shape a bit more.
Yeah. And the shape to me is basically this. ServiceNow is trying to escape the old SaaS trap before AI springs it. If software used to get valued on seat growth, agentic AI is awkward, right? Because the whole promise is fewer humans doing the work. So when Bill says 50% of net new business now comes from a non-seat-based pricing model, that's not a cute pricing tweak. That's them trying to bill for the work itself.
So wait, in human terms, if the customer has fewer employees next year, but a lot more software agents running around doing tickets and approvals and security checks, ServiceNow still gets paid?
Exactly. Maybe more. And he gave that very Bill McDermott line, "You like consumption? Great. But as soon as you show them how big the value is, they say, I'll take the seats. So we got you covered there." Which is actually revealing. They're keeping both meters on the wall, one for predictable budget buyers, one for usage spikes. It's pretty clever.
It is clever. Also, slightly sneaky in the best enterprise sales way. Like, whatever form your procurement committee uses to say yes, they've pre-built it.
That's enterprise software at its finest, yes. But the deeper point is what they need to own for that model to work. If you're charging for digital labor, then connectors, data fabric, asset visibility, governance, security, all the boring plumbing suddenly matters a lot more. That telecom example from the call stuck with me. More than 85 fragmented apps, a quoting process that took 3 months. Then with their CRM and CPQ stack, it drops to 1 week. That's not just nice app. That's system redesign.
So the company becomes less like renting seats in a software building and more like charging tolls on the roads between the buildings.
Yes, that's well put. And it helps explain why they're buying so aggressively. Visa closes in March, Armis is lined up, and then right after quarter end, they secure a $4 billion term loan to help fund Armis. Historically, this was a very clean story, cash-rich, subscription-heavy, not much debt drama. Now the capital structure has, more texture, let's say.
Texture. Again, you and your texture. But no, fair. This is the bit where the spreadsheet gets fingerprints on it, because suddenly it's not just great workflow company. It's great workflow company turning itself into a broader control layer and borrowing to do it.
Right, and investors have to decide whether that's disciplined expansion or a very expensive costume change. Management insists it's the first one. They were pretty explicit that these deals are about expanding the platform, not plugging a revenue hole. I think that's credible, actually. But here's the tension. Bill also said, quote, "So we can actually acquire a substantially interesting company and not impact the margin at all," which is kind of cool, because most companies will make excuses. Great line, very Bill, but the formal guide still says Armis is a 125 basis point headwind to Q2 operating margin and about a 200 basis point hit to full-year free cash flow margin.
So, no, not no impact. More like we'll absorb the bruise and keep smiling.
Exactly, and that matters. Because the bull case is not that acquisitions are magically free, it's that the core engine is strong enough to swallow the cost and still grow over 20%. That's a different claim, and a more believable one. If they pull that off, then the margin dip is a choice, not a loss of control.
I think that's where the stock got grumpy. Investors like transformation in theory, but only if it arrives in sterile packaging. No debt, no integration drag, no awkward quarter where the math gets fuzzier.
That's basically it. Seat-based SaaS was easy to model. This new version is harder. It's subscriptions plus consumption plus connectors plus cyber plus M&A plus a term loan, maybe a bitter business long term, but definitely a more complicated one to underwrite in the short term. And markets, they charge a premium for simplicity.
Also, if you're promising to be the operating system for digital labor, you can't really afford to look sloppy on margins or capital allocation. The standard goes up, not down.
Yes, and to their credit, they seem to know that. The buyback, the talk about getting SBC into single digits, the willingness to keep full-year margin targets pretty healthy even with Armis coming in, that's management saying, we know the rules of credibility. The question is whether investors believe the wider platform story enough to live through the transition.
Which is, I guess, the real hinge from here. Is this quarter the start of a more durable ServiceNow or the start of a much more complicated one that the market keeps discounting until it proves itself?
Both, probably. I think the business may be getting sturdier at the exact moment it becomes harder to model. Markets hate that phase.
So it's not something broke. It's more like, show me the new machine works before I pay up for it.
Right. Q2 is the first clean test. They guided subscription revenue to about $3.815 billion to $3.82 billion, and CRPO growth around 19.5% in constant currency. but ARM adds about 125 basis points to that growth and takes 125 basis points out of operating margin, which they see at 26.5%. That's the trade, basically.
Which means next quarter is less about fireworks and more about control, right? Can they integrate, keep demand healthy, and not spook people on profitability?
Exactly. And if some of those delayed Middle East deals finally close, great, but I really wouldn't build the whole case on geopolitics suddenly behaving.
Very modest ask from the world. Yes.
Bill had that line, in the short run, markets are voting machines, and right now uncertainty is winning the vote. Slightly theatrical, sure, but fair. Investors are voting against complexity.
And maybe against confidence that sounds a bit too glossy, because there is still real stuff sitting in the background. New debt, integration drag, and that federal investigation still hanging around the public sector story.
Yes, the bullish case from here is not faith, it's execution. If they can still hit the raised full-year subscription guide, roughly $15.735 billion to $15.775 billion, while holding about 31.5% operating margin, then this starts to look less like empire building and more like a platform widening on purpose.
I like that. It's not a reinvention, more like adding lanes to a highway while traffic's still on it.
Nicely put. Risky work, but not crazy work.
All right. That's probably our note. Strong quarter, stricter proof standard.
Yeah.
Thanks for hanging out with us, everybody.
Yeah, thanks, folks. Talk soon.
If you want these earnings chats to just pop into your feed, you can follow the show. And just as a quick side, this episode was put together with AI tools using the company's earnings release and call transcript as source material. So if you've got thoughts or a ticker you want us to dig into, send it to earningsunscripted@datamadness.ca. And thanks for spending a little time with us.
See you next quarter.